Hello everyone, welcome to the market opening bell for Thursday, January 29th, your 10-minute guide to the stock market. Hong Kong stocks rose significantly on Wednesday. The Hang Seng Index opened 198 points higher and extended gains throughout the day, closing at the session high of 27,826 points, up 699 points or 2.6%. This marks 6 consecutive days of advances, with a cumulative rise of 1,339 points or 5.1%, reaching a more than 4.5-year high. The Hang Seng China Enterprises Index climbed 267 points or 2.9% to close at 9,512 points, while the Hang Seng Tech Index gained 145 points or 2.5% to finish at 5,900 points. Total market turnover reached 361.5 billion Hong Kong dollars for the day. Southbound funds recorded total transactions of $137.8 billion, but net outflows amounted to $3.427 billion, marking 4 consecutive trading days of net outflows. Among the flows, net buying included Tencent holdings at $1.209 billion, Mart $733 million, YOFC $297 million, Sino $285 million, and Kingsoft Cloud $164 million. Net selling focused on Tracker Fund at $2.317 billion, Alibaba $944 million, Zijin Mining $854 million, China Mobile $748 million, and SMIC $379 million. According to statistics, Southbound funds have net bought Sino for 6 consecutive days, totaling $1.694 billion. Net bought Tencent for 4 consecutive days, totaling $3.488 billion. Net sold China Mobile for 18 consecutive days, totaling $14.788 billion. Net sold Alibaba for 4 consecutive days, totaling $3.071 billion, and net sold Zijin Mining for 3 consecutive days, totaling $2.773 billion. Technically, the Hang Seng Index has finally broken out of the rectangular consolidation pattern between 25,086 and 27,381 points. The measured upside target points to around 29,500 points, with an initial target of 28,000 points. Mainland China's A-shares showed mixed performance. The Shanghai Composite Index closed up 11 points or 0.3% at 4,151 points. The Shenzhen Component Index rose 12 points or 0.09% to 14,342 points. The Chinex Index fell 19 points or 0.6% to 3,323 points. Combined turnover on the Shanghai and Shenzhen exchanges totaled 2.97 trillion yuan. The renminbi central parity rate against the US dollar was set 103 pips higher at 6.9755 per US dollar. On the Hong Kong stock market, gold-related stocks performed strongly. Spot gold continued to break records during Asian trading hours, surpassing $5,300 per ounce and reaching a high of $5,311.68 per ounce, with year-to-date gains exceeding 22%. Spot silver once hit $116.11 per ounce. Japanese government bond yields surged sharply, which may drive increased safe haven demand for funds. Ongoing policy uncertainty in Japan, potentially lasting until the February 8th election, could keep safe haven demand elevated. China Gold International releases 2026 annual production guidance for the Jiama mine. Copper production is expected at approximately 140 million to 149 million pounds. Gold at 70,732 to 75,554 ounces, and silver at 4.18 million to 4.82 million ounces. For the Changshan Hao mine, gold production is projected at 70,732 to 83,592 ounces. Oil stocks continue their upward momentum on the news front. The U.S. Central Command, responsible for Middle East operations, stated on the 27th that its 9th Air Force will conduct a multi-day air readiness exercise. This comes amid ongoing U.S. military pressure on Iran. Additionally, a severe winter storm sweeping across the U.S. strained energy infrastructure and the power grid, causing U.S. oil producers to lose up to 2 million barrels per day of output over the weekend, about 15% of national production. Geopolitical premiums have helped oil prices build the bottom and rebound in the off-season, and with demand recovery plus global strategic reserve restocking, oil prices are expected to bottom out and rise in Q2 to Q3 to 6. Mart shows strong performance with gains once exceeding 9% reached $236, hitting a new high since late October 2025. On the news side, reports indicate that Mart is planning a new overseas offline expansion into North American outlet malls and large shopping centers. This move had not previously appeared in the company's publicly disclosed expansion plans. It is understood that Mart is engaging with mature North American shopping center systems, extending its site selection beyond traditional core malls to include outlets and large integrated shopping centers. A source close to the company said Mart has indeed partnered with U.S. real estate group Simon to add offline stores in more than 20 Simon shopping centers and the Mills locations across the U.S. The core goal of this expansion is to broaden coverage of Mart's key IPs in mainstream North American consumer scenarios rather than focusing on short-term sales surges. New Oriental announced its second quarter results for the period ended November 2025 with net revenue of $1.191 billion, up 14.7% year-on-year. Revenue from overseas exam preparation grew about 4.1%, while domestic exam preparation for adults and university students increased about 12.8%, and the new education business achieved 21.6% growth. The new education business has become a strong growth engine post-transformation, primarily consisting of two core products: non-academic tutoring, focused on arts, sports programming, and critical thinking courses, which has expanded to about 60 cities across China and saw 1.058 million student enrollments this quarter, and intelligent learning systems and devices with 352,000 active paying users this quarter, also covering about 60 cities, using hardware and digital courses to boost self-study efficiency and serving as a high-margin project. The company recorded a net profit of $45.5 million, up 42.3%. Non-GAAP operating profit reached $89.1 million, surging 206.9%, driven by improved operational efficiency and resource utilization in the education business. Non-GAAP operating margin hit 7.5%, up 470 basis points from the same period last year. Non-GAAP net profit was $72.9 million, up 68.6%. New Oriental expects third quarter fiscal 2026 net revenue between $1.313 billion and $1.349 billion, up 11% to 14% year-on-year, and has raised its full fiscal 2026 net revenue guidance to $5.292 billion to $5.488 billion, representing 8 to 12% growth. Oriental Selection reported results for the 6 months ended November 30, 2025, after the painful period following the separation from with Hui Travel and top streamer Dong Yu Hui. The company successfully turned profitable. Total revenue rose 5.7% year-on-year to 2.3 billion yuan, with net profit of 239 million yuan compared to a net loss of 96.5 million yuan in the same period of 2024. Gross profit increased 14.5% to 841.6 million yuan, and gross margin improved from 33.6% to 36.4%, mainly due to healthy development in self-operated products and live e-commerce. Self-operated products now exceed 800 SKUs compared to just over 100 last year, with the GMV share surpassing 52.8% of total GMV, effectively boosting overall profit margins. As of November 30, 2025, cash and cash equivalents stood at 1.2 billion yuan, time deposits at 1.9 billion, and financial assets at fair value through profit or loss at 2.4 billion, totaling 5.5 billion yuan in monetary funds. Nine Dragons Paper issued a profit warning, expecting net profit of approximately 2.15 billion to 2.25 billion yuan for the 6 months ended December 31st, 2025, up 216% to 230.7% from the same period in 2024. The profit growth was mainly due to higher sales volumes and prices, plus lower raw material costs, leading to a substantial increase in gross profit. U.S. stocks rose early but retreated later. The S&P 500 briefly surpassed the 7,000-point mark for the first time intraday, but closed down slightly by less than 1 point at 6,978 points. The Dow Jones rose as much as 146 points early, but ended up just 12 points at 49,015 points. The Nasdaq gained 40 points or 0.2% to close at 23,857 points. The Nasdaq China Golden Dragon Index, reflecting Chinese concept stocks, rose 25 points or 0.3% to 7,892 points. Alibaba's ADR gained 1.7%. United Health rebounded 4% after plunging nearly 20% the previous day, becoming the top gainer among Dow components. Among heavyweight tech stocks, Nvidia rose 1.6%. Reports indicate Nvidia will shift some 2028 chip production from TSMC to Intel. Intel stock surged as much as 12% on Wednesday. Supply chain sources note that under U.S. manufacturing policies and tariff pressures, major U.S. chip makers have long explored cooperation with Intel, though meaningful collaboration may not begin until mass production of 14A chips in 2028 due to current limitations in 18A technology. Microsoft released aftermarket results for the second fiscal quarter, ended December last year, with net profit up 60% year-on-year to $38.46 billion and adjusted EPS of $4.14, beating expectations of $3.97. Revenue rose 17% to $81.27 billion, above the expected $80.27 billion. Azure and other cloud services revenue grew 39%, below the prior quarter's 40% and slightly missing the expected 39.4%. The stock fell over 4% in after-hours trading. U.S. Telecom, AT&T, reported fourth quarter fiber net additions of 283,000, above the expected 272,000. The company forecasts free cash flow exceeding $21 billion in 2028, far above expectations, and adjusted earnings per share for 2026 between $2.25 and $2.35, above the expected $2.21. Its stock rose about 5%. The Federal Reserve has expected kept interest rates unchanged, maintaining the federal funds rate target range at 3.5% to 3.7%. The decision passed with 10 votes in favor, while 2 officials dissented in support of a rate cut: Stephen Miran and Christopher Waller, a contender for the next Fed chair. The post-meeting statement acknowledged the possibility of future rate cuts but provided no specific conditions or timeline. At the press conference, Chair Powell said the economic growth outlook appears stronger than at the last meeting. Inflation is largely in line with expectations, and labor market data indicates stabilization. When asked about recent dollar fluctuations, he declined to comment on the currency. Our stock pick today is SITC International, stock code 1308. SITC International has issued a positive profit alert, expecting unaudited profit attributable to shareholders for the year ended 31st December 2025 to be approximately $1.2 billion to $1.23 billion US, representing an increase of approximately 16% to 18.9% compared to the year ended 31st December 2024. During the period, container volume was approximately 3.85 million TEUs, up about 7.8% year-on-year, while the average freight rate was approximately $753 per TEU, up about 4.4% year-on-year. The increase was mainly attributable to stable expansion in the Asian market, which drove higher container volume for the group, and to the group's positioning as a premium service provider, which supported higher freight rates. The group operates 82 trade routes, including 16 operated through joint venture services and 25 operated through slot swap arrangements. These trade routes, together with its onshore integrated logistics network, cover 82 major ports in mainland China, Japan, South Korea, Taiwan, Hong Kong, Vietnam, Thailand, the Philippines, Cambodia, Indonesia, Singapore, Malaysia, Brunei, Bangladesh, Myanmar, and India. The group's fleet consists of 119 vessels with total capacity of 185,787 TEUs, comprising 101 owned vessels and 18 chartered vessels, with an average fleet age of 9.4 years. Of these 119 vessels, 95 are below 2,000 TEU and 24 are in the 2,000 to 3,000 TEU range. In addition, the group operates approximately 2.1 million square meters of yachts and 180,000 square meters of warehouses. Amid changes in the global trade landscape, intra-regional trade has become more frequent, driving strong demand for flexible and efficient small container vessels. At the same time, the aging of small container ships is becoming more evident. The group is monitoring industry supply-demand dynamics and adjusting its fleet structure accordingly to reduce emissions. In the first half of last year, out of the group's total capital expenditure of $72.1 million US, $31.9 million was used to purchase containers and $30.8 million was used to purchase container vessels. The group will continue to optimize its unique operating model, focus on expanding its service network in Asia, increase route density, extend its integrated sea-land service value chain to meet customers' ongoing need for stable supply chains, and strengthen refined management to reduce costs and enhance efficiency. Recommendations: buy at $28.8, target $31.2, stop loss $27.4. I do not hold the above stock.